Wells Fargo is the fourth largest bank in the U.S., with more than 4,800 branches in the United States. We are all aware of the famous red logo with its iconic stagecoach and 6 horses. But how did this company grow to be a household name in U.S. banking before being mired in scandal not once, but twice? Welcome back to Corporate Catalysts, where we take a close look at the world's most recognizable businesses, brands, and icons. This is the story of Wells Fargo from the beginning to the present day, and the scandals of Wells Fargo that shocked the world. Wells Fargo & Company is an American financial services company that is known around the world. They work in 35 different countries and serve more than 70 million customers. It is a systemically important financial institution according to the Financial Stability Board, and it's one of the 4 largest banks in the United States, along with J.P. Morgan Chase, Bank of America, and Citigroup. Wells Fargo & Company was formed by Henry and William G. Fargo in 1852. Henry Wells, born on December 12, 1805, in Thetford, Vermont, USA, embarked on his professional journey in the transportation and express sectors. In 1850, he established the American Express Company in collaboration with William G. Fargo, with the primary emphasis on delivering express and mail services. William George Fargo, hailing from Pompey, New York, born on May 20, 1818, was not only a skilled businessman but also an express agent. His professional journey commenced as an express agent for Harnden and Company in Buffalo, New York. Fargo later joined forces with Henry Wells to establish the American Express Company in 1850. Their aim was to provide shipping, express mail, and banking services in California. At this point in time, the industry was flourishing due to the gold rush, and Henry Wells and William Fargo wanted to make the delivery of goods faster and cheaper than regular mail in the U.S. After the California gold rush, Wells Fargo became the largest company for sending packages and handling money in the western part of the United States. They shipped a lot of gold in addition to delivering items that people needed. They were the main lender for the Butterfield Overland Mail Company, which had a long route of 2,700 miles from the Southwest to San Francisco. In 1860, the Overland Mail Company faced financial failure and couldn't pay back the money they owed to Wells Fargo. Consequently, Wells Fargo took over the complete 2,700-mile route across California. In 1870, Wells Fargo was in charge of all the roads connecting the West Coast to the rest of the country. They had the biggest group of stagecoaches in the world. In the next 100 years, Wells Fargo joined many other companies through mergers and acquisitions. In 1905, Wells Fargo split its banking and delivery services. The banking arm of Wells Fargo merged with the Nevada National Bank to create the Wells Fargo Nevada National Bank. In the First World War, the U.S. government took over Wells Fargo's delivery business and turned it into a government agency called the U.S. Railway Express Agency, REA. After the war, the REA became private again and kept running until 1975. In 1923, Wells Fargo Nevada joined with the Union Trust Company, and they became the Wells Fargo Bank and Union Trust Company. In 1954, they made their name shorter to Wells Fargo Bank. After 4 years, they merged with the American Trust Company and became the Wells Fargo Bank American Trust Company. In 1962, they changed their name back to Wells Fargo Bank. In 1968, Wells Fargo changed to a federal banking charter and turned into Wells Fargo Bank, N.A. During that year, Wells Fargo joined forces with Henry Tryone's Sonoma Mortgage through a $10.8 million stock transfer. This move made Tryone the biggest owner of Wells Fargo until Warren Buffett and Walter Annenberg had more shares than them. In September 1983, there was a big robbery at Wells Fargo called the White Eagle Robbery. It happened in West Hartford, Connecticut. A person who worked at Wells Fargo and drove the armored truck tied up 2 co-workers and stole $7.1 million. The government of Cuba helped with the robbery. The stolen money was first taken to Mexico City. After that, it was shared between Mexico, Cuba, and Puerto Rico. The robbery was investigated and led to legal actions for many years. In the 1980s and 90s, Wells Fargo bought several other companies. In 1986, it got Crocker National Bank from Midland Bank. Then, in 1987, it got the personal trust business of Bank of America. In 1988, it got Barclays Bank of California from Barclays PLC. In 1991, Wells Fargo spent $491 million to get 130 branches in California from Great American Bank. In 1996, Wells Fargo bought First Interstate Bancorp for $11.6 billion. But integrating these 2 companies didn't go well. There were numerous issues, including merging the back-end computer systems of the 2 companies, errors appearing in accounts, Many of First Interstate Bancorp's executives that initially came on board in the acquisition eventually leaving. In May 1995, Wells Fargo achieved a significant milestone by becoming the first major financial services company in the United States to provide internet banking. After buying several companies, Wells Fargo Bank was itself bought by Norwest Corporation in 1998. The new company took on the name Wells Fargo. Then, from the year 2000, Wells Fargo Bank started buying more companies. It got the National Bank of Alaska and First Security Corporation. In late 2001, it bought HD Vest Financial Services for $128 million, but later sold it in 2015 for $580 million. In 2007, Wells Fargo bought Greater Bay Bancorp, which had $7.4 billion in assets, for $1.5 billion. In the same year, it also bought Placer Sierra Bank and the construction unit of CIT Group. In 2008, Wells Fargo acquired United Bank Corporation of Wyoming and Century Bank shares of Texas. On October 28, 2008, Wells Fargo got $25 billion from the United States Department of the Treasury through the Emergency Economic Stabilization Act. This money was in the form of preferred stock. Because of government stress tests in May 2009, the company raised $8.6 billion in capital. On December 23, 2009, Wells Fargo paid back $25 billion of preferred stock to the United States Department of the Treasury. Along with that, they also paid $131.9 million in accrued dividends. In total, they paid $1.4 billion in dividends since they got the preferred stock in October 2008. In 2010, the trust company operations of Wells Fargo in the Cayman Islands were bought by Citco, a hedge fund administrator. In 2016, Wells Fargo was involved in a monumental fraud scandal. Wells Fargo clients began to notice the fraud after being charged unanticipated fees and receiving unexpected credit or debit cards or lines of credit. Initial reports blamed individual Wells Fargo branch workers and managers for the problem, as well as sales incentives associated with selling multiple solutions or financial products. The story was later changed to blame top-down pressure from higher-level management to open as many accounts as possible through cross-selling. This was thereafter referred to as the Wells Fargo cross-selling scandal. The Wells Fargo cross-selling scandal involved the creation of millions of fraudulent savings and checking accounts on behalf of Wells Fargo clients without their consent. As head of Wells Fargo's community bank, Tolstedt oversaw an aggressive cross-selling strategy that resulted in more than 2 million fake bank and credit card accounts being opened without customers' consent or knowledge. News of the fraud became widely known in late 2016 after various regulatory bodies, including the Consumer Financial Protection Bureau, CFPB, fined the company a combined $185 million as a result of the illegal activity. The company faced additional civil and criminal suits reaching an estimated $2.7 billion by the end of 2018. The creation of these fake accounts continued to have legal, financial, and reputational ramifications for Wells Fargo and former bank executives as recently as March 2023. After previously denying any wrongdoing, Tolstedt became the first Wells Fargo executive to be held criminally culpable for a scandal that resulted in the firing of 5,300 employees for falsifying bank records and other ethics violations. In 2017, there was new light being shed as it was discovered that the number of fake accounts created by Wells Fargo was more than the 2 million originally thought. Wells Fargo eventually admitted that this report was accurate. The new number? A whopping 3.5 million fake accounts, which is a staggering 80% increase from what was originally reported. By June 2018, Wells Fargo sold all 52 of its actual bank branches in Indiana, Michigan, and Ohio to Flagstar Bank. In September 2018, Wells Fargo said it would reduce costs by $4 billion and announced a plan to cut 26,450 jobs by 2020. In March 2019, the CEO Tim Sloan resigned because of the Wells Fargo account fraud scandal, and the former general counsel C. Alan Parker became the interim CEO. On September 27, 2019, the company announced that Charles Scharf would be the new CEO. In May 2021, the company sold its Canadian direct equipment finance business to Toronto Dominion Bank. In 2021, they sold the Wells Fargo Asset Management Division to private equity firms GTCR and Reverence Capital Partners for $2.1 billion. In 2022, Wells Fargo found itself at the center of yet another scandal. The U.S. Consumer Financial Protection Bureau, or CFPB, hit Wells Fargo with the watchdog's largest ever civil penalty on Tuesday as part of a $3.7 billion agreement to settle charges over widespread mismanagement of car loans, mortgages, and bank accounts. For example, some customers' auto loan payments were not applied correctly to their balances, which led to them being charged higher interest, late fees, and, in some cases, wrongful repossessions. To make matters worse, these repossessions were also mismanaged, including how the vehicles were sold after repossession. In other instances, Wells Fargo wrongly reported some customers as deceased and overstated attorney fees, which meant that mortgage loan applications were denied instead of approved, and this brought thousands of wrongful foreclosure actions. There were also scenarios where some customers were charged monthly fees when they shouldn't have been charged anything. All in all, this was not a good look for Wells Fargo, and the total number of customer accounts that were affected by this scandal is mind-blowing. 16 million accounts were reported to have been impacted, which resulted in the $3.7 billion penalty. By the way, this amount is the largest fine ever issued to a bank by the CFPB. Wells Fargo has taken steps in an attempt to revamp its image and rebuild trust with its customers. Since the first reports of scandals, they have overhauled their leadership, replacing 80% of senior executives and over 70% of the operating committee. They have also taken steps to review and overhaul their risk and compliance frameworks, and have run marketing campaigns in which Wells Fargo admitted its wrongdoing and focused on steps the bank was taking to rebuild trust. Nowadays, Wells Fargo is one of the 4 largest banks in America and is part of the Big Four. They have more than 8,000 branches and 13,000 ATMs. The bank has assets worth over $1.8 trillion and is expected to exceed $2 trillion by the end of 2024. 2 of the biggest owners of Wells Fargo shares are Vanguard Group and BlackRock. Wells Fargo has been around for 170 years, and it seems like it will keep doing well for a long time. And there you have it, the enthralling story of Wells Fargo, a polarizing name in the world of banking. What are your thoughts of Wells Fargo and the scandals they have been involved in? Do you consider Wells Fargo to be a trustworthy bank today? If you currently bank with Wells Fargo, what do you think of their current service? Leave a comment down below and check the thumbnail on your screen for another riveting tale. We'll see you there.